All right. For those of you who've just joined us, thank you guys so much for coming in. Once again, my name is Kutso. I form part of the SAIL International team's tax department. Today's webinar is on offshore employees working in South Africa. Now, before we get started, I just want to direct your attention briefly to the disclaimer on screen. Please note that the contents within this presentation are a generic interpretation of South African tax law, and it is intended to guide your offshore employees to ask the right questions in order to, one, accurately fulfill their tax obligations and know what they must do. Now, due to the complexity of tax legislation, we do highly recommend that you consult a tax professional for any specific or tailored advice regarding your situation, as the certain aspects within this discussion cannot be applied as a blanket approach. Another thing that I just wanted to mention before we get started, unfortunately, while I am presenting, I cannot see the chat box. So you're welcome to pop your questions in the chat section as and when we go through the webinar. Towards the end of the webinar, I will address any questions that are in the section, and I'll give a few minutes for anybody else who has any questions to ask. If anybody's feeling a little shy to ask their specific question, you're more than welcome to scan the link at the end, book a free 15-minute consultation with one of our tax advisors, and we'll be happy to run through anything discussed within this webinar in more specific details. Now, just a brief outline of what we're going to be discussing today. So we're going to start off with the South African tax system, how that applies to offshore employees, the source principle, and how that affects offshore employees, your employer requirements. So as an employer, either in South Africa or outside of South Africa, what are your obligations? The very, I want to say, popular digital nomads that are enjoying Cape Town weather as we speak. Double tax agreements and how they affect your income as an offshore employee. And as a last note, tax planning, the importance of planning and understanding what your tax obligations are. Once again, if you do have any questions as and when we go through the webinar, you're welcome to drop them in the chat section. I do not have access to see the chat section while I'm presenting, so I'm more than happy to address them at the end of the webinar. All right, so to get us started, just a brief lesson, I guess. South Africa works on what we refer to as a residency-based tax system. This means that your tax residency will be based on mainly three principles, which we will discuss in more detail as the presentation progresses. First one is ordinarily residence. Second one is physical presence. And third one is being exclusively resident under the provisions of the double tax agreement. For those who are considered tax resident on either of these principles, you will be taxed on your worldwide income. This means regardless of where it is that you earn the income, South Africa will have first taxing rights. For those of you who are not resident, as many offshore employees will be, you will only be taxed on the income that is considered sourced from within South Africa. Now, it is important to note that everyone in South Africa, unfortunately, will be automatically considered tax resident unless there is evidence that contradicts this. And we will discuss that further on. If you are an offshore employee, the biggest advice that we can give you is to have your tax status confirmed with SARS based on the three residency principles, so that you can confirm how you're being taxed or what your obligations are in terms of South African tax. Now, the key terms that will be firstly applicable to all employees, but mostly to those who are considered offshore employees. First one is the resident principle. As mentioned earlier, residency is based on three principles or three tests. First one is ordinary residence, which will look at a person's fixed or most settled place of residency, among other factors, to determine if South Africa would be your natural home or the place that you would ordinarily return to. Now, common misconception, citizenship in South Africa does not determine tax residency, nor is it affected by it. All it acts as is an influencing factor to see if this would be the place that you would naturally return to. The second test or principle is the physical presence principle, which is considered secondary and applied if you are not ordinarily resident. This test looks at the number of days that you spent in South Africa before you can be considered a tax resident. So for context, it's 91 days in each of the 5 tax years before the year that we are focused on, 91 days in the tax year that we are focused on, and a total combined number of 915 days over the past 5 tax years before you can be considered tax resident. Another little tax tip, if you do leave South Africa again for 330 days or longer on a continuous basis after being considered tax resident, you will then be eligible to break your tax residency on the 331st day. And then lastly, we have exclusive residency under the double tax agreement, which will largely be determined by an agreement between South Africa, which is concluded and into effect, and the country of your residence. Now, this will vary from country to country, but each agreement will have what we call a tiebreaker test. And if applied, that tiebreaker test will determine where most of your ties are and therefore where your residency will be for tax purposes. Now, the second term that will be applicable to offshore employees is the term of remuneration. Now, in terms of South African legislation, remuneration means any amount which is paid or is payable by any person by means of a salary, leave pay, overtime, bonus, gratuity, commission, or any fee, etc. Whether this is in cash or otherwise, or whether it is in respect of services rendered or not. Now, the term remuneration will very largely tie back to the definition of gross income for those offshore employees, which is defined as income considered taxable in South Africa. Now, again, for offshore employees, we have to remember that you need confirmation to be non-resident for tax purposes. So it's not automatically applied. But the definition for gross income only includes income from a source within the Republic if you are not a tax resident. And for those who are resident, worldwide income tax basis. Now, if you are seconded to South Africa but earn other income, say maybe rental income abroad or interest income, these should ordinarily not be included in your income and should not be taxable in South Africa. But once again, it's not automatically applied. So it's always something that you need to check with SARS to see the system that they've placed you on so you know how you're going to be taxed. Lastly, we have employer responsibilities. Now, a lot of the people hiring offshore employees will be resident employers, but there are some non-resident employers that we will discuss a little bit later in the presentation. But for context, fourth schedule of the South African Tax Income provides, or Income Tax Act provides for responsibilities for every employer who is firstly resident to pay remuneration and deduct or withhold any amount of employees' tax as determined by the relevant sections. And then lastly, the responsibility will be for that employer to then pay over the withheld amount to SARS within the prescribed time limits. Now, the provision specifically applies to resident employers. So if you are a digital nomad or a remote worker whose employer may not be considered a resident, the responsibility to pay income tax has not been extinguished. It's just been shifted from your employer to you in your personal capacity. Now, there has been recent changes that have moved or that have obligated non-resident employers who have a permanent establishment in South Africa and given them the responsibility to withhold tax and pay it over, but we'll discuss that in more detail as we go along. Now, before we continue, just a brief reminder of South African tax rates, which are applicable if you earn an income. Our tax system is a progressive one. So that means that your income is taxed at specific rates for certain increment stages. So say, for instance, you earn 500,000 Rand. The entire 500,000 Rand will not be taxed at the 31 percentile tax rate. So for example, to break it down a little further, from your 500,000 Rand income, 237,100 Rand will be taxed at 18%. After which any amount above that 237,000 and below 370,000 will be taxed at 20%. And then after that, any amount above 370,000 500,000 and below 512,000 will be taxed at 31%. So it's progressive in nature. The nice thing is that they've already calculated certain portions of tax for you. So a lot of the times you only need to calculate the last slice of tax in order to determine how much your overall tax will be. All right. So offshore employers, some general obligations that you might have from a tax perspective if you are working in South Africa. Every individual in South Africa who earns an income is obligated to register for an income tax number. This is for one of two reasons. Firstly, to maintain a record of the income that you are earning, and secondly, for employers to allow them to accurately fulfill their obligations, withhold the employees' tax and pay it over to SARS accurately, as well as other little levies, so your SDLs, your UIF, etc. So all offshore employees must register for income tax on the basis of source, which we will discuss a little bit later. Now, what people tend to confuse this obligation for registration for income tax with is the requirement to firstly register for an e-filing profile and also to submit tax returns. Although everyone is obligated to have an income tax number if you are earning an income, not everyone is obligated to submit an income tax return. Now, on SARS's website, what you will often find, which is quite helpful, is a brief questionnaire for those of you who would like to confirm whether you need to submit a tax return or not. But the questions that they ask mainly are, did you receive any income? So this question will look at whether you're getting income from a trade. So if you own a business or if you are an artist who sells their artwork and so forth, whether your income that you're earning is from employment, either as an independent contractor or as an employee. So for residents, this question will also look at whether the income that you are earning is from a foreign employer. And then for offshore employees, these ones will largely look at whether your employment is South African based or otherwise. Now, and then the last one is income from sale of assets, which is often referred to as capital gains. Now, if the answer to that question is yes, the second question then will look at whether the combined total of that income that you earn is above or below 91,250. This is because if it is below, there will be no tax payable due to the various deductions and the rebates that will eventually nullify your need to pay income tax. But for those who earn above 91,250, then you have the responsibility to complete and submit your tax returns, correctly declaring all income earned if you are tax resident in South Africa, or alternatively, South African sourced income only if you are non-resident, so for our offshore employees. And then lastly, as an offshore employee, you will be required to safekeep the records of your income. So this is pay slips, are P5s if you are receiving them, invoices if you are invoicing for your services, and to also keep a record of the total number of days that you spent in South Africa. We will address the importance of this aspect a little bit later in the presentation, but SARS generally has a safeguarding or safekeeping protocol of about 5 years prior of all the income tax returns that you filed. If you haven't filed any income tax returns, it is advisable to keep all your records subject to certain relevant prescription limits. SARS can ask you for a tax return that backdates the 5-year period, but 5 is generally the accepted time limit for that. Now, I did mention we're going to address quite a few things. So we're going to start on tax on source. What does that mean for you as an offshore employee? And what do you need to consider? Now, source refers to where the income is considered to come from. So the source that it comes from. There's usually a two-step approach. Firstly, we determine the originating cause. And then secondly, we determine the location of that originating cause in order to determine whether it will be sourced in South Africa or not. Now, even if you are non-tax resident, so for example, when you are an offshore employee rendering services for a South African employer or otherwise, it may be considered sourced in South Africa and therefore taxable in South Africa. An added layer of complexity is with remote workers who may not be rendering these services for a South African employer. Now, for this reason, what South African case law has then done is codified and advised that the originating cause specifically for employment income is where the work is being rendered. So the accepted approach is that income from employment should be taxed in the country where the services are actually being rendered, irrespective of where the contract is entered into, where the employer is based, whether they're South African or not, or the bank in which you pay the remuneration into. So what they'll always look at first is, where are you? Are you sitting at your laptop in Joburg, or are you sitting abroad, say for instance in London, where you're rendering the services? And then that will then determine whether you are considered, whether there is tax on source or not. So simply put, an offshore employer, whether you're a digital nomad, remote worker, or a traditional employer, physically rendering the services in South Africa will render you liable for income tax under the domestic laws for employment income in South Africa. So that's the first one. Secondly, there is what we call tax on work days. You'll remember a little earlier on, we addressed that you need to keep a record not only of your income, but of the total number of days that you do spend in South Africa. This is because for offshore employees specifically, whether remote, digital, or otherwise, your income will be taxed on the actual days spent working in South Africa. So SARS will often differentiate between what we refer to as work days and incidental days. For context, incidental days are days that are not intended for work, but you incidentally render some services. So say you're on holiday, but you have your laptop and you just happen to check your emails that day, or you take a work call on that specific day. So that day will not necessarily qualify to be a work day, and therefore you won't need to pay tax on it. But if you are in South Africa and there is a certain number of hours specifically directed towards working, that's what you will then pay tax on. So the gross income will then be calculated on that. Okay, now what is taxable? So yes, you're going to be taxed at source. Yes, you can be taxed on work days, but generally, whether you are offshore and even those who are South African employees, you get taxed on salary, bonus, your allowances. So these are amounts which are granted by the employer to the employee to cover any business-related expenditure, benefits, amongst other things, usually non-cash goods, which your employer provides to you as part of your remuneration package. There are instances where you can get taxed on the sale of an asset, but this is only if the asset specifically is situated in South Africa. Any interest earned in South Africa may also be subjected to tax in South Africa. Now, it is important to consider that there are exemptions that can apply to either minimize or completely exempt you from tax for a specific thing, such as interest. So once again, we urge you to confirm your status with SARS, because then that will directly confirm your tax obligations and whether you're only paying it on the income that you've earned from the services that you've rendered, or interest is also included in that, or other income will also be included in that. Employer responsibilities. Now, before we move on, I do know that this webinar is quite a bit of a mouthful. So if you do have any questions, you're more than welcome to drop them in the chat box. We will address all the questions towards the end of the webinar. But earlier on, we spoke about employer responsibilities and how this specifically often refers to resident employers. So prior to 2023, only resident employers, so those are employers who are considered tax resident either by place of effective management or permanent establishment, or their representative employment candidates, are obligated to register for and withhold payee. If there was no representative individual, the employee would then be responsible for settling his or her own personal tax liability. Now, around December 2023, and therefore post 2023, and as it stands, non-resident employees who have a permanent establishment in South Africa are required to register as employers, and therefore, for payee purposes, withhold the relevant taxes and pay it over to SARS. Now, the term permanent establishment can be quite a tricky one to ascertain, so it's not going to be discussed in detail within this specific webinar. Now, this provision for non-resident employees who do have a permanent establishment in South Africa impacts those who opt to work in South Africa remotely, i.e. from employers who are offshore, digital nomads, largely depending on their specific positions, and foreign companies who have South African branches mostly. Now, this means that if you are a non-resident employer who has a permanent establishment in South Africa, you will have the same employer responsibilities to register for income tax, withhold the necessary taxes, and then pay these over to SARS on behalf of your offshore employees. Now, again, as I mentioned earlier, the term permanent establishment is quite tricky and quite complex. And depending on your position within the organization and the work that you do when you are present, this is specifically directed towards shareholders or directors or people who are self-employed. So everyone who has their own business but is not registered under a specific umbrella of a company or a partnership. Depending on what it is that you do when you are in South Africa for work purposes, there is a possibility that you can create a permanent establishment by your presence in South Africa. So once again, it is important that you consult a tax professional to assess your situation, firstly, but also to plan your travels so that they don't coincide with your tax obligations or create unnecessary tax obligations. Double tax agreements. Now, as mentioned earlier, when you are an offshore employee, your tax obligations will depend on the reason that you're in South Africa. So whether this is like a time contract, so you're here on secondment for 2, maybe 3 years, or you're here to render a specific project for a client, or maybe you're on holiday and you thought the first 2 days will be directed to sourcing clients in South Africa before kicking back and relaxing. There are some important considerations that you'll need to consider. Firstly, the double tax agreements focus on the source of income as well. So you will note from the screenshot and the highlighted portions that it first looks at where the employment is being exercised. There are instances where even if you are rendering the services in South Africa, your residency country, so the country that you are originating from, will have taxing rights, and therefore South Africa will not be able to tax it regardless of the source. So this will depend on this will depend on the requirements that are listed on screen. So for instance, are you in South Africa for 183 days in any 12-month period or more? Is the remuneration that you are earning in South Africa paid by an employer who is non-resident? But a further one is, from that remuneration that is paid by an employer who is not resident, does that employer have a permanent establishment in the country that you're in, being South Africa? If the answer to all of these questions is no, then you will still be only taxable in your country of residence. So regardless of the source, South Africa will not have taxing rights over that income. Now, employment income, so the screenshot on here is for income from employment. So employment income will be treated differently from an independent contractor to a director of a company, or for instance, an artist or a sports person, or maybe you are rendering diplomatic services or government-related assignments. Those will have their own requirements and their own tax obligations as well. And the one that's often overlooked is students who come to South Africa but receive a stipend from a specific work-related contract for studying purposes. Those people will also have their own regulations on how that stipend should be handled. Usually it's based on residency, but once again, South African residency is not automatic. So you need to confirm it to make sure that it's not being taxed in South Africa while you are here. Now, in order to consider whether the income earned will be protected, you must first consider whether your country of residence has a double tax agreement with South Africa. Shockingly enough, we only have double tax agreements with about 42% of the world's countries. So that still leaves an overwhelming majority of about 58% that we don't have agreements with. And you need to then consider, what services you're rendering. If there is an agreement, then we can look at the obligations in terms of that agreement. You also will then need to consider how that income will be treated over and above the South African domestic provisions. So usually how it works is double tax agreements will take precedence over domestic law. So if you are taxed in South Africa on source, the double tax agreement can override that principle to then allocate taxing rights. Now, it's not a one-size-fits-all approach. There are a lot of options and a lot of things that you do need to consider. So it is advisable that you have a look at your situation. You know, are you a director? Are you just an employee? Are you rendering diplomatic services? So then you can then determine what your actual tax obligations are while you're in South Africa for that assignment, for that project, or as a digital nomad. Now, for those of you who saw the sneak preview of this lovely picture that I have up here, digital nomads are becoming, I want to say, increasingly popular, especially for those who travel specifically to Cape Town because they love the weather and they love working from there. But a digital nomad is a remote worker who travels to different locations while they are working. So when we refer to remote workers, we also refer to digital nomads who don't necessarily stay in a country long enough to trigger residency, so they move around quite often, but they are working from wherever they are situated. Now, for digital nomads, all our discussion points from this presentation are relevant. So tax and source, if you are in South Africa, how many of those days are you spending working? Those days might be considered taxable. Is there a double tax agreement that will then protect those days because you're spending less time? And so forth and so forth. So source will mean where you are physically rendering the services, and does that create tax obligations for you as an employee or as a digital nomad in South Africa? Double tax agreements is mentioned, and the tax status in your home country. So are we creating a situation where your home country and South Africa are creating dual tax residency, thereby making you taxable in both countries? Do we then need to look at the tiebreaker test to determine where your actual ties are at? But these are usually related to days spent. Now, additionally, remote workers do have the risk of creating a foreign employer's permanent establishment, as mentioned earlier. This will very largely depend on your position in that employment structure, so what it is that you do while you are in South Africa. So it's good to have it checked out. If you are concerned that you're maybe a little higher up in terms of the decision making, you are a director, a shareholder, whatever the case may be, then it might be wise to have it checked out and confirm that your presence in South Africa doesn't create, for instance, a permanent establishment. Now, there are new regulations in terms of the Second Amendment to immigration regulations, which have been altered. And essentially what they've said, or what they've provided for, is work conducted as contemplated in the relevant sections for a foreign employer or an individual who derives foreign source income on a remote basis. So if you're working in South Africa for a foreign employer, then what that act provides for is that if you are that type of person and you earn a gross income of no less than 1 million rand, then you can apply for a visa issued for a period not exceeding 6 months within a 36-month period. And the foreign worker or the remote worker may also apply to be exempted by the South African Revenue Services from registering as a taxpayer. Now, if that visa is issued for a period longer than 6 months, you will then be required to register with the South African Revenue Services, so that's SARS. And if applicable, you then need to comply with all the relevant legislation that governs employment of workers in South Africa. Now, many argue that this provision has provided a tax exemption of income earned in South Africa, but because it only requires you to register if you are earning above a certain amount. But it is important to consider that South African legislation is very hierarchical, which means that there will always be more favor provided to tax legislation over tax issues. So your source principles, your residency test will always take precedence in determining whether you need to be taxed in South Africa. Once again, as mentioned earlier, there's that minimum 91,250 Rand threshold for submitting a tax return. So there's still quite a bit of debate around this specific section and how it will be taken by SARS. But what we always advise is let's have a look at that overall situation and have a look at whether that specific provision, if you are a digital nomad earning below 1 million Rand, how would that then affect your tax obligations in South Africa? is there double tax agreements that could maybe act in your favor? And how do you then tax plan going forward? But we do anticipate that SARS and National Treasury will comment a little bit more on this to advise on how it is to be treated. Now, that does lead us to the end of our webinar. Now, global economy is changing. So working from home is becoming more popular. Digital nomads are loving Cape Town. I love Cape Town too. Whether during meetings or employees who are seconded or sent to South Africa, often those people are not advised on their tax obligations. So how we can help is maybe assess your employment obligations, your income structure, and advise where is it would it be that you will be maybe paying tax and you were not aware of, or submitting tax returns and you were not aware that you need to do that. We can help create a structure that prevents unnecessary tax leakage between different tax jurisdictions. So having a look at your home country, does the double tax agreement maybe offer a certain route for you so that you don't have to then pay tax in South Africa? How are you affected by this? We can also provide global tax advice involving the days that you do spend in South Africa. Are you, bordering on becoming a tax resident because maybe you're spending a little bit too much time in South Africa? With all of this, we do provide a free 15-minute assessment. So you are more than welcome to reach out to one of our tax advisors, and we'll be more than happy to assist you with any of the questions that you do have and to assess your overall structure. Thank you guys so much for allowing me to present. I'm just going to have a look at whether there are any questions. I'll allow just a few more minutes to ask for anyone who does have any questions to pop their questions in the chat. There's also a Q&A section if you prefer to put them there. So we'll just toggle between the two and see where there are any questions. But some frequently asked questions that we do have is, if I do exceed that 91-day period, I'm an offshore employee, I've been in South Africa for about 6 years now, but I intend to leave. How am I affected? What does this do for my worldwide assets? So usually what happens is at the point of entry, so this is after you've met the physical presence test and you've been here for about 6 years, 91 days each year and so forth. At the point of entry into South Africa, your worldwide assets as well as your worldwide income will then be included into the South African tax net. So that means that if you, for instance, came into South Africa and you had a property abroad, that property will then be taxable in South Africa. The rental income will then be taxable in South Africa. And if you were to then meet that 330 days test to become non-resident again, then what will then happen is that property will go through a deemed disposal. So they'll have a look at the value when you entered versus the value when you left to determine whether there's an exit tax charge that's applicable. So it can have some far-reaching consequences. So it is important to have a look at that. But yeah, I see there are no questions. I believe that the recording will be shared afterwards. So you're more than welcome to reach out if you do have any questions. There's a QR code that you can scan and book a free 15-minute consultation with either of our tax advisors, and we'll be happy to have a look at your structure and have a look at whether there are any tax concerns. But other than that, thank you guys so much for staying throughout the webinar. It's much appreciated, and I trust that you all will have a good day.